The COVID effect. Boom, skyrocket. I don't think management is aligned with investors. Gross. Is this sustainable? 52-week low. Pfizer, Johnson & Johnson, CVS. Let's take a quick look at them each, and let's take a look. Pfizer, first off. Now, guys, Pfizer is a company that we've talked about a lot in history. Here is the issue with Pfizer, the COVID effect. Look at the income statement for Pfizer over the last 10 years. Going down, flat, going down. They probably sold something here, and then boom, skyrocket. Is this sustainable? Well, it was a big thing having to do with COVID, right? And COVID will probably be around for a long time, but will it be as alarming as it was in these last few years? I don't know. I don't think so. Go down here. Look at their profit. I mean, it's all over the board. It really jumps up a lot in the last few years. Guys, the problem with drug companies is you got to look at their pipeline. What's in the pipeline? The more that's in the pipeline, the better. But it has to be high quality things that can add a lot to the bottom line. That's what's especially key here. COVID was wonderful for the company, but what is it doing going forward for the company? Are they going to still be able to get this major revenue from COVID? In my personal opinion, that's the scary part with Pfizer. That's why I'm avoiding Pfizer completely. That's my opinion. But if you have an understanding that's better than mine, by all means do it. But for me, I sit there and look at Pfizer and think, you know what? COVID was a good run up for them. Let me wait for things to stabilize. Let me get a better understanding of their pipeline, because that's essential. That's so essential for all these drug companies. So from this standpoint, let's check out their 8 pillars. So apart from their, which I don't even get, how is their ROIC so low? They just hit home runs with these companies. Man, that's really bizarre. That's a red flag for me. That's a major red flag for me. And their free cash flow average of the last 5 years is 18.5, and last year was 26. Find yourself the stabilized, normalized earnings and free cash flow for the company. That's very, very key for companies that have big jumps like this in earnings and revenue because of one-time events. Now, you might sit there and say, well, Paul, it's not one time. It's been going on for 3 years now. Fair enough. However, do we think that Pfizer will be generating revenue on COVID of some form in 20 years? Probably not. But are there other diseases that can make revenue for the foreseeable future? Yes, there are other diseases. There's a lot of diseases, and they're on the forefront, a lot of them. Or they will go out there and acquire companies that have leading forefront medications having to do, they can put it under their Pfizer brand. All right? That's very, very key here. Now, let's look at analyst estimates and see if they agree with me. Well, look at this. They're expected to do $5 a share this year, and it's going to decline to $4.32 over the next few years, and revenue declining as well, according to analysts. And again, take analysts with a grain of salt, but I think analysts tend to be a lot more optimistic than most people, and they're still showing declining revenue. So again, don't assume that this profit and revenue will keep increasing from here. This is probably not the baseline for Pfizer. Guys, if you like the software, we're running a special right now. It includes everything that you see here on tools, plus our community, plus our stock analyzer tool, which was used 1.3 million times last year. This will absolutely make you a better investor. $7 for 7 days. That's $1 per day. Sign up, try it out, everythingmoney.com. All right, next company. CVS. Let's pull up our friends at CVS. Okay. You know, some of the things that alarm me at CVS, very low return on invested capital. Very, very low. Very low return on equity. I don't like that. 5-year free cash flow is up. That's good. Sorry, 5-year free cash flow is $12 billion. Last year, 13.5. Dividends, 2.7%, doesn't eat up a lot of the shares. Now, guys, when you have this low return on invested capital, they need to be increasing this considerably. They don't do a good job of getting a return on the money invested in the business, so give more money back to the investors through dividends, through share repurchases if this was a much lower PE. High PEs are justified for high growth companies or companies that have a high return on invested capital, because you should be willing to pay a premium for companies that don't have to invest as much money to increase revenue and profit. This is bad. I do not like this. Let's go look at a company like Walgreens, their competitor. Let's see what their return on invested capital is. Wow, even worse. Makes me reassess my Walgreens. But they pay out a lot in dividend. I like that a lot. Okay, guys, this medical business isn't the best. Look at these profit margins. These drug companies and these pharmacies. These profit margins are garbage. Ugh, Gross. Market cap to enterprise value. Big difference. That's probably going to be their retail leases. Makes sense. All right, so for CVS, a bear case on CVS, I don't think management is aligned with investors. The way they give their compensation and their bonuses, you get to read the 10K. To give a quick recap, basically the way they base it on their operating earnings and their calculation of earnings per share, but the way they calculate their earnings per share is convoluted, and I'm not a big fan of it. So that is something that is hard. Now, on a $107 billion business, it tends to be harder to find really good management that's going to be aligned unless it's a founder as part of the management team, which it's not the case here, I don't think. So I'm not a huge fan of that. But one of the bonuses of CVS is they've really increased a lot of their online users and their digital platform users. That's a really great thing. The world is absolutely shaping, going towards that direction, and I love that a lot. So that's definitely a plus for CVS. Final company, Johnson & Johnson, JNJ. Let's check them out. Now, Johnson & Johnson, much different story in terms of return on invested capital. 12.8%. So the PE is lower than CVS, and the return on invested capital is double CVS's. Dividends paid, $11.7 billion, pays out 3%, and they can afford, they do have they must not have a lot of reinvestment opportunity for them to be paying such a high dividend. Because if their return on invested capital is this high, but they're still paying a high dividend, it must mean they feel we don't really have a place to really put the money, so we might as well return it to investors. And the stock isn't really that cheap to be buying back shares and getting excited about it. But look at this gross margin, 67% with a bottom line of around 19%. Now, I'm gonna use our stock analyzer tool here on this company because I just feel like this is a company to actually pay somewhat of attention to. 8 pillars, okay. The PE and the free cash flow is down. Let's check out the free cash flow here. See what caused it to go down. Looks like changes in working capital in the last 2 years drove down their free cash flow. But look at this free cash flow. 13.8, 15, 16, 15.5. I mean, it's just growing. A little bit lower here, but this is pretty solid. Now, guys, remember, our software, we added this line to make the math easy for you. I don't want you to sit there and go, okay, 21 minus 4. I want you to be able to see this. That's why we added this line to our software to make it easy for our users to make quicker decisions on companies. Don't spend your time doing calculations. We'll do that for you. Let's look for analyst estimates. Okay, not much growth here in earnings per share. Okay, not much growth. Revenue, not much growth. It's Johnson & Johnson. They're freaking huge. How many more Band-Aids can you sell to kids? I don't know. This is probably a Johnson & Johnson Band-Aid right here. I have no idea. So let's use our stock analyzer tool that was used 1.3 million times last year. Let's use it on Johnson & Johnson. Actually, one of the things I want to look at for cash flow, let's look at their acquisitions. A lot of acquisitions here, guys. A lot of big acquisitions here. So I look at this saying, okay, are they getting growth through acquisitions or are they getting growth organically? That kind of concerns me here. So I'm gonna do a 10-year analysis on our stock analyzer tool. Now remember, guys, every investment's the present value of all future cash flow, but we don't know the future, so we have to make guesses on the future. That's what investing is. It's an art. We have to tell ourselves a story, and that story will tell us what we should pay for the company today. The question is our story correct or not? That's why we have margin of safety. So, revenue growth. With inflation, I'm gonna go 2, 4, and 6. Profit margin, I'm gonna go 18.5, 19, and 19.5. Free cash flow, 19, 20, and 22. PE, 15, 16, and 17 on both PE and price to free cash flow. Now my desired return, I'm gonna do 10, 12, and 14%. Because I do think this is still low for everything. So I'm looking at going, actually, you know what? I'm actually gonna change this PE a little bit. I'm gonna go 13, 15, 17, because I don't think that this company justifies a really high multiple, even with a good return on invested capital. It's not that great. It's not like I'm like, oh my God, this is incredible. It's not like Apple at 37%. I'm gonna hit the analyze button. Now remember, if it's all green, it doesn't mean go out and buy. Go do more research, go understand, join our community right here with that $7 for 7 days so you can have a conversation with people about what's going on at Johnson & Johnson. Okay, so my desired return. All right, we have a low price of mid-80s, high price of 105 to 120, mid price of 95. The stock's currently at 155. Makes sense, not a fast-growing company, currently at 155, so it has to drop quite a bit because look at this P of 22. So guys, just be patient. Find another stock and be patient for the stock to hit the price you want it to hit. I have it on my watch list 100, so I can start selling puts at much lower prices. Thanks very much. Check out everythingmoney.com.